Hello, good morning. Okay, so um, I want to talk about the power of the hidden divergence this morning. And if you're seeing this video now, I want you to pay very close attention to what I'll be showing you, what I'll be sharing this morning. So I've discovered that yes, in my previous videos, I've talked about the power of the MA cross. And that's why what you're seeing in front of you is a perfect example of what I want to show you. So if you see, this is volatility 101 is, of course, my emphasis is always on crash and boom, okay, and it still stays there. But because I've seen this setup and I need to explain this to you, why you will notice that there was a cross, okay, why you will notice that there was a cross. Let me try to bring it up. There was a cross around here. If you check where I just placed that box, there was an MA cross. It's supposed to have come down, right? You would have expected it to come down, down. Okay, but after the cross of the moving average, which of course I've always said in my other video, the power of the MA cross. So you say, but there was an MA cross, why was it violated? Instead of the thing coming down, it just came down a bit and started buying up. So this happens with crash and boom. We're going to look at a few examples as we make progress. But the question is, why did this not respect the moving average cross? Why did it have to go up, violate it, and rather have another cross? If I want to increase it, you check there's a counter cross within the same short time. So this is exactly what throws people off balance most of the time when they are trading. And that's why this morning I want to talk to you about the power of the hidden divergence. Okay, in my teachings and my previous videos, I've really talked about regular divergences. Of course, when we're talking about divergence, we're talking about another word for divergence is opposition, opposite, mirror effect, contrary view, and all of that. And so I have really talked about the regular divergences and all of that. Now, divergences can be used for two main reasons. One, for determination of trend reversal, or for determination of trend continuation. The ones that is responsible for trend reversal are the regular divergence. And the one responsible for trend continuation are the hidden divergence. And that's what I want to talk about this morning. Excuse me, because I noticed that so many of us or so many traders really don't know the power of the hidden divergence. So I will talk about it this morning. Please follow me closely, watch the video. So now look at this. So we have hidden divergence has two types. We have the bullish hidden divergence for bullish continuation trend, and we have the bearish hidden divergence for bearish continuation trend. Now for hidden bullish divergence, the HBUD or the HBUD, price must make higher low and the oscillator must make lower low. That's the condition. When you see price makes higher low and your oscillator makes lower low, of course that's a hidden bullish divergence. What that means is that price is going to continue going up. Now for hidden bearish divergence, price must make lower high and your oscillator must make higher high. When you see that happen, that tells you that this is a hidden bearish divergence and price will continue to go down irrespective of the pullback. Okay, let me give you one key thing to note. You can only spot hidden divergences at the end of a pullback. It is the pullback in a progressive trend that forms the higher low or the lower high in any case. So you must be very sensitive to pullbacks. For example, a trend market could be trending upwards, like what you see here. It could be trending upwards. So how do you know that this market is going to continue going upwards? Of course, if you agree with me, you will discover that within this framework, within this chart, you can confidently say that there was actually some sort of regular bearish divergence, right? You may want to say that there was some kind of regular bearish divergence. How do I know? Let me tell you. Let me show you. So there was some kind of regular bearish divergence. I'm not talking about regular divergence today. I just want to show you the power of so If you see that, that was a regular bearish divergence. At that point, price was making, higher highs, and my oscillator was making a lower high. And of course, it did not have a long-term sell. Even when it broke out of the trend line, this is how far it could sell. Look at that, where I have that horizontal line. That's how far it could sell. So the question is, why did it not continue selling after there was even a cross? Some of the time we have this in crash and boom. So I'm going to use this as a perfect example to explain. I may look at a few examples with the crash and boom itself, because that's what I trade. And of course, I encourage people to trade, of course, for those who are interested in trading that. So but why did it not continue to go down? And there was even a cross. A lot of people ask me this question, and I try to answer them. But let me do a video now so that you will always make reference to this. Okay, the reason is because there was a hidden divergence. That's a simple truth. Why the moving average was violated, why the regular bearish divergence could not play long, was simply because it was violated. It was what? Violated. And what actually violated that first move is the hidden divergence. So let's look at it. Okay, and please, this is very important. You have to look at it now. So this was what was supposed to be projected. It was supposed to come down, but it didn't come down. It actually went up, and simply because there was a divergence. So let's look at where the problem came. Now let me show you what happens. I said this is a hidden bullish divergence, telling you that price is going to continue going up. So what we do is that we spot a higher low here. Okay, we spot a higher low. So this was actually a retracement point. Okay, this was actually a retracement point. This retracement was what gave this particular higher low. So having gotten that replacement point, the next thing I want you to look at is look at your oscillator. In this case, we have to come to our RSI. So we draw. Our RSI gave us a lower low. That was it. As soon as you find this in any asset, remember that there must be a pullback. Like I said, it's a pullback that gives you an idea if there's going to be a hidden divergence or not. Don't always be on the lookout for regular divergence. Of course, you can blame that on me, because I have really emphasized much of the time, more of the time, about regular divergences. But this is where it is. You must be when you want to be a trader, you must be versatile. You must be expansive. You must make sure your analysis covers every age, so that before you take a decision, you would have considered every factor within. So this is a not regular now. This is a hidden bullish divergence. Price is making a higher low here, and the oscillator is making a lower low. Now, anytime this happens, forget about the moving average cross. Moving average cross is just an indicator based thing, and it lacks. Actually, what really matters is price. And remember that everything around the market, the fall and the rise of the market, depends on market structure. Market structure is the beginning and the end of every market. Every market within the sphere of trading, of a chart, falls and rises with market structure. You must understand that. That's the origin of everything. And there are some very key things I may not necessarily say here because of time, but the point I'm trying to make is that in every time frame there is a remarkable structure. In every time frame, quote and unquote, there is a remarkable structure. Why I'm saying so is because time frames helps you to determine time frames. Let me explain this now. If, for example, you're looking for a bullish market structure, or a bullish structure, so to say, on a 1 hour time frame, and you are not able to spot that, if you increase that time frame and maybe try to enlarge it, you will discover that there is truly there may be a bullish structure there, but you couldn't see it on a 1 hour time frame. What that means is that the 1 hour time frame, the bigger time frame is the upper set. The smaller time frame, you couldn't find it, is a subset. So sometimes you may not find a clarified structure on a lower time frame, but if you extend it, you may find it in a bigger time frame. So what I'm trying to say is that market structure holds across every time frame. It's just that you may not find it at a particular time frame does not mean that there is no market structure in it, including consolidation. Consolidation could be a leg. A ranging market could be a leg of a market structure in a bigger time frame. It's just that your eye may not be able to find it like that. So I hope that we'll find time one of these days to do a video on that extensively. So this is what I'm trying to say, and this is actually what happens in this kind of structure. When you find this happening, what is advisable to do is that you hit the market. Let's look at a few examples and let's see if it can help us. So let's go to crash 1000. Let's see if we can find, hidden divergences. Good. Okay. All right. So let's see something. Okay, we're going to check. Okay, I found another example. So here, very good. So you follow me now. Look at it. Price was making a higher low here, right? Remember that there is a cross of amazing. There is a cross here. Let me bring the cross out. If you check here, sorry, please. If you check where you have that box, there is a cross of the moving average. So we're expecting crash to have dropped. Seriously, right? Okay, but why didn't it drop? Let's look at it. If you check, you will discover that there was a hidden bullish divergence there. Price was going to continue going up. This was already a growing, that is a bullish trend, and then there was a pullback causing the lower high, sorry, the higher low, all right, on the price now, and then oscillator was making a lower low. As soon as you find this, do not worry yourself, it's not going to sell, it's going to continue going up. And if you the distance between here, this point where this market ended and the pullback to these points to the top gave almost, let's see, gave almost 35 pips plus. Okay, so that is just what it is. So you must be sensitive to these kind of pullbacks. If there is a pullback in a progressive bullish trend, find out if it has created a higher low. If it has created a higher low on the price and there is no lower low on the oscillator, look out for something else. But if there is a higher low and there is a lower low on the oscillator and they are vertically aligned, what I mean by vertically aligned is this. I've always said this. Try to look at what I mean by vertical alignment. So if I were to draw a straight line, the straight line will cut across where my higher low is and where the price and oscillator is. Look at that. Okay, so if I were to draw a line to touch, you will see that there is vertical alignment. I'm not drawing this line this way and this one is coming this way. Do you get it? My price, look at what I'm saying. This and this are almost vertically aligned if I were to draw a straight line. You get it? Not that this one is here and this other one is here. You get it? They must be vertically aligned so that it means that you're talking. That's why we say divergence is mirror effect. It means opposite. There must be an opposite, relationship with the lines, either ascending or descending. Okay, so that is that, and I don't want you to ever miss it. So you don't be in a hurry to jump at a trade. You have to look out for these divergences, because a lot of people, when they see the cross, moving average cross, why is it violated? Simply because market structure and pattern is stronger than whatever moving average it is. Yes, we may not necessarily need to avoid, to neglect the power of the moving average cross, but when market structure is involved, you need to have a rethink, and that is exactly what happened here. The hidden divergence is powerful. Now, so far, what I've been showing us has been bullish, hidden bullish divergence. So let's see if we can find a regular, sorry, not regular now, a hidden. Let's see if we can find a hidden bearish divergence. Remember, so what's the catch for this, for bearish hidden divergence? Price, it must be in a sell trend in the first place. Remember that you want to determine if this sell trend will continue or it will reverse. If it's going to reverse, you have to look out for regular bullish divergence, okay, because you are looking at trend reversal. But if it is actually a sell trend, right, and you want to find out if the trend is going to continue selling, what you need to look at for is going to be something called a hidden bearish divergence. In that one, price will be making lower high and your oscillator will be making higher high. So the question is, have we found one? I think I found one example. So let me just show you. The example I found is this. You see that price is making a lower high, my oscillator is supposed to be making a higher high. Okay, in this case I've not seen a very strong higher high. Okay, but let me explain something. When you see where there is a double top on your oscillator, is a weak divergence. Okay, otherwise we're supposed to have a higher high situation here, but this one is a weak. Anytime it is flattened, it has a double top, it's a weak oscillator. What that means, it's a weak divergence. What that means is it's going to sell, but it may be sluggish. Look at the sell, it actually sold massively, but you see this is where we cut it. So this was actually selling, so this later pulled back, pulled back, you know, and then formed a lower high. All you need to do is, if it has formed a lower high and it was on a sell trend, you come to the oscillator to look for a higher high or an equidistant kind of stuff. Okay, so that was that. But let me just go to maybe 1 hour time frame. I will see a few things there. Okay, so look at this. This has been a sell market. Okay, this has been a sell market. So the question is, okay, so let us see how this will work out. This is actually an active market, so let's see what happens. So price is making some sort of lower high there, right? Good. And then my oscillator is making a higher high. Okay, still not making a higher high, or is slightly a higher high. Okay, this is better than the first one. Now if this is true, if this is going to happen, price is making low, except this lower high is broken. But if it remains this way and my oscillator is making this, I'm expecting this market, let's check it later. The time is 4:25 now. Let's see what happens to crash 500 later. This is what I'm expecting. If this hidden divergence will hold, that price is going to continue coming down. Okay, just simply because there is a hidden bearish divergence. Price is making a lower high, oscillator is making a higher high. So we expect that this should rebound at this point and start coming down again. So let's see what happens between now and 9 a.m. today. Today is 27th of 27th of February. So let's see what happens between now and 9 a.m. or 10. Let's see where price will go. But if this is really true and it works, then this is going to supposed to come down. So you as a trader, you must be sensitive to this. You don't just begin to buy because it is buying. And secondly, this is almost at a rejected area. It has rejected this area. So because of this hidden bearish divergence, we may have to see price pull down again, pull down to the downside. Okay, all right, so this was another example within the same structure here. You will agree with me that price was making a lower high here, and then we'll see later price was making a lower high there, and then we'll see later was making a higher high. So okay, a flatten, that is to say a weak bearish okay, not really very weak, but that was what it is from here. And then we saw price come down from that point. Price came down as soon as that happened and started the journey again. And then we have another situation here. We're expecting price to come down. Okay, so that is what hidden divergence is. Price will be making lower high on hidden divergence. That is because the market was originally trending downwards, and then you want to find out if it's going to continue trending downwards. Look out for hidden divergence and all of that. So this is what this is about. Okay, this has nothing to do with regular divergence. I've talked about this. So this is purely on divergences. Let's look at another example. Let's see if we can find something else. So this is boom. Okay, so this is boom 500. Why is this market selling at this point? It's as simple as what we have just explained. First and foremost, this has been a sell market. Price went up and continued coming down. Why was that happening, or why did that happen? It's very simple. Let's look at H4. Why H4? I mean H1. So we come back again. Price is making a lower high here, and then we want to find out what our oscillator is doing. Oscillator was making a double top. Remember that double top in this case signifies weak, but it means something. Okay, it means something. When you see that price making a lower high, oscillator is flat or making a higher high, just know that price is going to reverse at that point and start coming down. It's as simple as that. So this is actually what happens in some of these cases. Okay, if price is making a lower high and your oscillator is not making a higher high, please do not sell. I mean, do not even think of selling. This is another typical example. Please look at this screen. It will help you a lot. Look at it. I've been able to spot a lower high. Okay, price has been trending downwards. You want to find out if it's going to continue selling, and the oscillator is making a higher high. It's as simple as that. And because of this singular movement, you discover that the market is going to continue trending, and then from that point it started trending to this bottom. The distance between let me show you, between where this market started pulling back to very important to determine a price, what do we call it, price continuation. Reversals are mainly for regular divergences. So I want to believe that going forward, from after watching this video, you'll be very careful in your choice of entries, because this will help you to know. Always remember to draw this. Always remember, check out your oscillator and see if there is a contrary view, that is divergence on it. This is hidden divergence, and then find out, because the problem is, you see, sometimes, and remember, let me show you something. You know, this is boom, and anytime we find a cross in boom, it starts spiking to the upside. If you check, before this thing looks like it was violated, there was actually a cross here. I can assure you that there was a cross here. This thing actually crossed, but because it started pulling back down, that's why the cross was violated. It was actually a cross. So because you saw the cross, you would have thought that it's going to bite to the sky. No. Find out if there is a lower high, that is a hidden bearish divergence, and then there is a corresponding, reflection on your oscillator. If that happens, be rest assured that you will not be buying, but rather you'll be looking at selling. So that is what it is about. Let me just do a refresher so that you can have it in your notes and take out time to spot these things. It will help you a lot. It will help you to know when a trend, a pullback has ended. That's what one of the things that hidden divergences does. And then where you can make an entry, of course, after every pullback. So back to this, the power of the hidden divergence. It has the power to push market, to continue in its previous, trend. So like I said, bullish divergence, bullish hidden divergence are basically used for bullish continuation trend, and bearish for bearish continuation trend. So take note of that for hidden bullish divergence, price must make higher low and oscillator must make lower low for it to be a hidden divergence and for you to be able to continue buying in this case. And then for a bearish divergence, for you to continue selling, price must make lower high and your oscillator must make a higher low. I want to really believe that this short and informative video will help you in your in your entries going forward. And if you have any question, feel free to ask question in the comment section. I'll be willing and so excited to get back to you. Thank you very much. And for the last time, remember that the last video before this one now, I had talked about the WPR. The WPR does a perfect job, and so far it has helped a lot of people within the mentorship community to improve in their trades and all of that. I want to use this very opportunity to appreciate all of you who are still with us and who is still learning. Learning is a continuum in this case, and let's continue to improve on our trading and our learning, and let us not give up. I want to appreciate all of you for staying through, and God bless you. Thank you very much for all you've done and for your time, and have a great morning. Cheers.